John is regularly sought after by the national media, including CNBC, Bloomberg, and others. John is the Executive Vice President and Chief Investment Strategist for LPL Financial. In his role, he leads the market and economic analysis for LPL's research team and is responsible for the firm's strategic and tactical investment advice. Vectra Wealth Advisors are supported by LPL Financial, which provides an integrated platform of proprietary technology, brokerage, and investment advisory services to more than 14,000 advisors across the country. I know we are in for a treat today with his information. Please welcome John Lynch to the podium.
Clap along if you feel like a room without a roof. Clap along if you feel like happiness is the truth.
Thank you, Bruce, and thank you, everyone, for the warm welcome. Appreciate the opportunity to share our thoughts with you, and LPL Financial clearly is honored and privileged to share in your 25th anniversary, so congratulations on that. My friend and colleague and manager, Bert White, wanted me to send his very best to you, and he said it's been a magnificent experience for him sharing with you these last several years, and I personally am delighted to have the opportunity to do so. I believe you mentioned this was livecast, though, and since my annual performance review is next week, not only is Bert White a very smart man, but he's a very handsome man as well. Moving on to the 2018 market outlook, it's never too late to suck up. We called our 2018 market outlook at LPL Financial the return of the business cycle. Now, the genesis of this was basically 30 years of frustration on my part. Every September, early October, I sat in investment policy committee meetings, and we all said to one another, how the heck are we going to come up with 5 or 6 investable themes? What can we repackage? And it was every year, and many of our competitors, we've done it in the past, and I thought, how can we simplify things? Let's come up with one theme and see how that manifests itself through policy decisions, economic decisions, the fixed income markets, and the equity markets. So we came up with the return of the business cycle. Now, the whole idea is not to suggest that we are in the early innings of the cycle, but rather what we're attempting to suggest is that we are returning to the normal drivers of the business cycle, okay? And what we're doing here is we've really spent the last 8, 9, 10 years dependent on the largesse of unelected, appointed, academic central bankers, whereby elected fiscal legislators were not necessarily running infrastructure spending, tax reform, regulatory procedures that would run commensurate with record low interest rates. So consequently, we had an environment, as Patty highlighted, that we didn't necessarily have the coordination, if you will, necessarily between fiscal and monetary policymakers. And clearly, the people have spoken. Maybe 5% of the West has had exposure to risk assets. Risk assets are up 300% from the low. I think about March 8th, 2009. The S&P 500 closed at a devilishly low 666. Okay, today we're at 2820, and that's after 2% sell-off of these past couple of days. And I remember that day fondly. I was a Wachovia employee at the time. The stock had gone from 60 to 1. It was a very humbling experience. I'll be working till I'm 95, but nonetheless, I love what I do, thankfully. But I remember coming home that night, and the kids were younger. I haven't changed at all, but the kids were much younger then. And I'm sure I looked awful. And my wife just looked at me. She's like, what the heck happened? So I just said, well, the market fell by more points today than any time in history. And my son was immediately concerned, would Apple survive? Would all his technology work? I said, yes, son. And my daughter looked at me and she said, so the market fell by more points than any time in history? I said, yeah, hon. She said, how many points are left? I'm thinking, my little girl's ready to double down, So anytime you have a bad day in the market, you think of my daughter, okay? How many points are left, all right? The power of compounding. Warren Buffett would have been proud of her. So what we've seen this experience where monetary policymakers have been driving everything, But the 5% or so who have been exposed to risk assets have been the beneficiary of this, whereby the rest, the working class, if you will, the hard workers, we've not seen that. So consequently, we have in the West, Scottish referendum, Brexit, roller coaster approval ratings for Shinzo Abe, the rise of anti-establishment parties, the rise of anti-establishment candidates. So consequently, I think fiscal legislators are A, getting the hint that it's time to act, and B, businesses are in a situation where they've been hoarding cash for 8 or 9 years. Let's spend on chips and software to maintain market share. But by year 8, 9, and now we're approaching year 9 of the cycle, businesses are of the mindset that we better go out and start attaining new market share, investing in property, plant, and equipment, moving forward, not getting caught up in the hunker down mentality, if you will. Businesses have been in a situation where they've largely been taking financial risk. The aforementioned Apple, they issued debt to pay yield because they could. They had more money than the US government, but they issued debt to pay a dividend. Okay, they just played the game as, rightfully so. But you're in a situation now where business is saying, do we want to buy back shares and pay dividends, or is it time to start investing in property, plant, and equipment, start taking economic risk to move forward? And I think that's so critically important because Patty talked about the dynamic balance between services and manufacturing growth. And while we've seen growth in both, I would submit if services represent 80 or 85% of economic output, manufacturing might represent 15 or 20%. But I would submit that manufacturing represents 80% of the economic volatility because services are largely locally consumed, locally produced, so it's more of a steadier trajectory for growth. So this manufacturing thing I think is going to be really key because we've got some mojo behind manufacturing now, and as I highlight shortly with the incentives for business investment, I think you finally have that coordination between monetary and fiscal policy, and I think that's going to be very important. Now, I also want to point out that I have a very talented research team, very smart people. Every management book I've ever read said, hire people smarter than you. Well, Burt White already did that for me. Everybody on my team is smarter than me. But I want to emphasize that we have no talent. We have a very talented marketing and creative team that came up with Return to the Business Cycle and made it come up with this whole movie type theme. Okay, so I have nothing to do with that, but I'm grateful for their partnership because they've made a boring research report make it come to life. So we're very pleased with our partnership with our marketing and creative team. But when you think about now that you have that better balance between fiscal and monetary coordination, how that's going to play out in fiscal decisions, economic decisions, policy decisions, and how investors are going to invest and how the market's going to define winners and losers. Because when the Fed was printing money, essentially, creating electronic reserves, increasing their balance sheet by a factor of 5, we basically had an environment where a rising tide was lifting all boats. The firm pays me to worry. And stocks and bonds and gold were all going up. Either you're going to die or you're not. The market's freaking out at some point, but everything was rising. So now we're in a situation that the Fed is no longer in the printing mode, if you will. I think it's going to be a more fun investment environment. It's going to be a more volatile investment environment, but I think it's going to enable investors to divine the winners and the losers to help determine which companies, for example, have rising accounts receivables. If they have rising account receivables, maybe their clients can't pay them, maybe they can't service their existing debt. You can screen that group out. So maybe the whole passive thing, which has been outperforming the last several years, and we're still advocates of passive investing, but passive has outperformed active these past several years, and we think that dynamic is going to shift over these next couple of years. Now I want to talk about the return of the business cycle in 4 areas. Again, policy, the economy, bonds, and stocks, okay? From a policy standpoint, elected officials in the West have gotten the hint, right? Scottish referendum, Brexit, our election last year. And I think investors are starting to appreciate the fact that fiscal leaders realize, particularly here in the US, regardless of how one felt about the speech last night, I always find it so fascinating how half the room stands, half the room sits, and it's just really, we were talking about earlier, couldn't they all sit together and mix it up a little bit? But be that as it may, we're not here to solve that issue today, unfortunately. We'll be here all day. We'll have to open the bar if we go too deep. But what we're seeing is that fiscal leadership clearly is taking the mantle from monetary leadership. And to Patty's point about how long is this thing going to last, we think it has a couple more years to go at a minimum. Because historically, I'm going to throw some fun facts at you. After the Fed raises rates the first time, it takes 4 years before the economy slips into recession. So purely using that historical measure, December 15, we took rates from 0 and we catapulted all the way up to 0.25%. Okay? We've raised 4 times. All right? We're at 1 3/8 right now. The Federal Reserve is meeting today. We don't expect the Fed to raise rates. But wouldn't it be funny if Fed Chair Janet Yellen, who was not reappointed to her role, if she decided to stick it to the man and raise rates today one more time? Today we will find out if Janet Yellen is a bitter woman. Okay, we will find that out for sure. I suspect not. I think she's a very gracious, warm, and humble human being, and also perhaps among the best economists we've ever seen in the US. So, but nonetheless, we've seen this environment. Okay, so that shift from monetary leadership to fiscal leadership is really going to be important. I'd be remiss not to talk about the tax plan. We think the tax situation is terribly important from a consumption standpoint and a business investment standpoint. We were surprised that they were able to get it done before year-end 17. Given some of the other challenges from a legislative process, we thought it would take a little longer. But nonetheless, they did get it accomplished. And again, regardless of where you feel, I always try to separate all the political aspects and look at the economic impact, which should flow through to interest rates, which should flow through to corporate profitability. And what we've seen is at this point in the cycle, this sort of transition to supply side is probably beneficial for not only the economy, but for the financial markets. Was a huge advocate of the demand side policies, government spending, for example, and monetary policy, which got us out of the Great Recession or the financial crisis. But now to elongate, you really need to pass that baton. And from the fiscal changes, what we've seen is $1.5 trillion over the course of the next decade. The original House version was to be 60% or so to the consumer and 40% to businesses. Once everybody got their fingers in it, it's 77% to consumers. I'm sorry, 77% to consumers and 23% to businesses. So what that means is this first year, the U.S. consumer is going to get about $120 billion in relief. Businesses, the way they had their the 5-year immediate expensing, that's $333 billion, is 23% of the $1.5 trillion. Because of the 5-year structure of immediate expensing, I don't think any business is going to undertake that in the 5th year, right? So we're assuming they're going to do $330 over the next 4 years, approximately $80 billion a year. So if the consumer is going to get $120 this year, businesses will have $80 billion. That's $200 billion in relief on a $20 trillion economy. That's 1% to GDP. Going into next year, when consumers get the AMT refund, that's $200 billion alone to the individual. So when you think about the 4-year cycle from the Fed raising rates, that would suggest December of 19. If you just look at 1 and 2% of GDP from the tax law in 18 and 19, we definitely think it's front-end loaded. I'm not convinced it's going to persist through 20, 21, 22, but we think 18 and 19, we should be able to dodge the recession bullet purely because you have this shift from monetary to fiscal leadership. You'll have a boost to consumption, and you'll have a boost to business investment as well. So what this will mean from a policy standpoint, I talked about the Fed with the rising tide lifting all boats. Now we're going to see a decrease in market correlations. And what that means is it's a geeky way of saying stocks, bonds, and gold will not all be moving in the same direction anymore. And perhaps more importantly, as an investor, stocks won't be moving in the same direction. You'll see different sectors moving in different directions. You'll see different industries within sectors, different sub-industries within sectors moving in different directions. So as correlations decrease, that's much more of a fundamentally driven environment. It's more of an environment where, excuse me, I get so choked up talking about this stuff. It's an environment where active management will outperform. It's an environment where we believe fundamentals will help drive. If when we were purely counting on the Fed printing money, it was a technically driven market, it was a rising tide lifting all boats market, it was a passive-led market. if you will, index funds outperforming. Now we're seeing the shift toward more fundamentally driven, and we think when you look at your statements over the next several quarters, I think we still want you to have exposure to passive, but I think you're going to start to see the dynamic shift and to see more outperformance from some of your active holdings. From a business investment standpoint, we think that's certainly going to favor the technology area. Technology did very well last year. We don't think it's going to do as well this year, but nonetheless, from a repatriation aspect from the technology area, they had the largest component of profits held overseas as not absolute numbers, but profits as a percentage of market cap. And we think that's going to be a beneficiary for the space, plus global demand, plus increased business investment. You know, they're still going to spend on chips and software, because part of the challenge with the economy, as I'll get into a second, as Patty mentioned, you know, the challenge of, you know, how many more workers do we have, you know, at 4% unemployment. So the real key will be for business to start spending on CapEx, capital expenditures, or business investment to enable productivity to start growing, so we can create more output per hour worked. So from a business investment standpoint, that's going to benefit technology. It's going to benefit the industrial space. Industrials will be a beneficiary of property, plant, and equipment, global demand. They pay higher taxes. So there are several scenarios. In fact, the market, after being down 500 points over the past couple of days, I noticed just before I spoke, we're up 200 at the open, and Boeing was leading the way. So you're starting to see those industrials really embrace what the president talked about last night from the public-private partnership infrastructure spending standpoint. So we think that's going to bode well for that sector. From tax reform, deregulation, you know, there are 4 ways government can affect policy or affect the economy. It can be trade, it can be taxes, it can be monetary policy, and it can be regulation. Well, I think we're all scratching our heads on what's going to happen with trade, because some of the things that were posited during the campaign haven't necessarily come to fruition in the administration. I think that's kind of a condition that all presidents have experienced, the idea that governing and campaigning are entirely different scenarios. So I'm not sure that the trade aspect will be as bad as initially feared, but nonetheless, we have to be mindful of that, because if you go back to the 1930s, the big mistakes we made, which elongated the Great Recession, were Smoot-Hawley tariffs, raising taxes, and a Fed being too aggressive. So it looks like we're going to dodge 2 of those 3 bullets, but hopefully we will dodge the 3rd bullet as well. So from a tax reform standpoint, financials tend to benefit very well. And I want to emphasize the regulation aspect also when I'm talking about financials, because tax reform, certainly financials tend to be a higher paying sector. But as the Federal Reserve, you know, everyone wants to talk about Jerome Powell, who is the next Fed chair after today's meeting. But Randall Quarles was already sworn in by the Senate, confirmed by the Senate a couple of months back. And Randall Quarles is the vice chair of supervision at the Federal Reserve. And he is an advocate of reduced regulation on the banks, wants to minimize the stress on the stress test, reduced Tier 1 capital ratio requirements. And all those proposals would suggest an additional $250 billion in lending capacity this year and next. So we think, again, another 1% of GDP, 1+% of GDP. So that is a real positive development that we think will help drive the financial space. Tax reform should also help the small cap space. Small cap stocks tend to spend the most, but as the Federal Reserve gradually raises interest rates now, I've been wrong thus far on this call, and I'd like to emphasize, you know, if you're doing this for 30 years, you have to kind of have thick skin. So I haven't been wrong on this call. I've been early on this call, okay, about the dollar getting stronger, because the dollar has continued to weaken. Everyone talked about a strong dollar in 14 and 15, and it really only had a strong period of strength in the first quarter of 15, then it's been kind of meandering. And I think investors really globally want to get a better handle as to how aggressive Jerome Powell will be raising rates. But when you see the tax situation, small caps tend to have most of their business in the US, so they are not impacted negatively by a stronger dollar when you see, like multinationals are, when they have to convert their earnings back to US dollars, when they convert overseas earnings to US dollars. So we think small caps are going to benefit from not only, I'm hesitant to say the dollar is going to strengthen. Now, an analogy I've used in the past You know, I flew in yesterday, 4-hour flight, went to the hotel gym, I worked out, left the gym. At 55 years old, did I leave stronger or did I leave less weak? Okay? I left the gym less weak. Okay? And I want you to think of the dollar as less weak going forward as the Fed simply takes rates from historically low levels to ridiculously low levels. Okay? And be mindful that trade also plays into this, which is why the president was talking about, and Treasury Secretary Steve Mnuchin last week, we're talking about it in Davos, a stronger dollar because they want to make sure we can reduce import. They mentioned a weaker dollar because they want to increase exports. So there's a dynamic there that, you know, it's kind of been challenging since really the Nixon administration when John Connally, former governor of Texas, Treasury Secretary, he was in the car with Kennedy. In 1970, he was talking to the G8 or whatever, and he basically said, it's our dollar, but it's your problem. And we've essentially run a bombastic currency regime for the past 40 or 50 years, and we need to be mindful of that. And I think last week was a great example when you saw the zigzag from the policy makers or the administration and Treasury. So be very mindful of that. We think the dollar is going to become less weak as opposed to stronger, and we think that supports small caps as well. And the rising rate environment, as Patty mentioned, rates are rising, but again, we don't think, we're taking rates from zero. They're still negative in many parts of the developed world, so the whole idea that we're going to have rates shooting through the roof, I think, is short-sighted, and I'll highlight that a little more in a second. So from a policy standpoint, think about correlations, think about tax reform and regulation, think about rising rates and how we think that will benefit financials, industrials, technologies, small cap, and clearly a tailwind for the value space. Okay, the value space clearly has underperformed the past year or so, and we think that style of investing is going to have an increased bid, not only because growth, PEs, price to earnings ratios, are more expensive, but because the value components, energy, materials, industrials, financials, they tend to be beneficiaries of recent government spending. So when you look at the economy transitioning from policy to the economy, we think global growth will grow about 3.7% this year. We are advocates now because of the new tax law here that our original forecast was for 2.5%. Now we think the tax law can be responsible for at least 50 basis points or 0.5% to economic growth. But be mindful of what's happening globally. You know, we're firming up in the West. People are very excited about what's happening in Europe. Europe did dodge a few bullets last year with the elections in the Netherlands and in France. We're not convinced populism is dead. We have the election in Italy coming up in a few months, and it could be a very important result because populism, I think, there is very strong. Italy is the 4th largest bond market in the world. So people are minding that very closely, and I think all investors should be prepared for that. I think if you're looking for the next global risk, it could be the Italian election, because if populism stands firm there, then suddenly, you know, we could have a circus in the U.S. politically, but it's not going to threaten the Union. Greece was important these last 5 or 6 years because they did not want to give a currency using member precedent for an out for the currency, okay? And they really didn't, in my opinion, didn't care about Greece. They just didn't want a path in case it was Italy or Spain, much larger credit markets. So I think that's something we need to be mindful of. But nonetheless, we are firming in Europe, but a lot of that is driven by monetary policy. We certainly have crumbling infrastructure throughout much of Europe, and to the degree we can get some sort of coalition, if you will, on some sort of sovereign credit to help repair infrastructure, to help solve some of the immigration challenges there, put people to work, you know, a WPA part 2.0, if you will, in Europe. I think that would be helpful. In the emerging space, we've been very excited there. You know, fiscal policy certainly is playing more of a role going forward in the West and in Japan. But in the emerging space, I think they've done a magnificent job addressing slower growth from China. They've taken full advantage of our weak currency to attract investment in their economies, and they've used that investment wisely, not solely focusing on classic emerging style, export-driven manufacturing or commodity-driven juggernauts. They've really tried to embrace healthcare, technology, things along those lines. So the emerging economies, as you'll see on this next chart, probably growing, a hair below 5%. The developed world, a hair below 2%, and the US growing about 2.5%. I mentioned earlier the firm pays me to worry, and I'm sleeping wonderfully when it comes to inflation. You know, historically, wages are the primary driver. I know we've got a lot of small businesses here, right? So what is your largest cost? And don't tell me entertainment. It's wages. And if wages are only growing 2.4, 2.5% over the course of the last year, historically wages have to grow 4.5% on an annual basis before the Fed feels the need to slam on the brakes, topple the economy into recession. And we're a long way from that in our estimation. So we're kind of in this sweet spot. We can nudge up rates slightly. We have a 4% unemployment rate. Does anyone believe the unemployment rate is 4%? You know, I think the underemployment rate, which Patty and I can converse on, U3 and U6, we'll spare you all those geeky stuff. But nonetheless, the underemployment rate is about double the unemployment rate, and we think that's more representative at LPL, what's really going on in the economy. You have several dynamics going on. Why the participation rate is low. You have globalization, you have boomers. You mentioned you were a boomer, I'm a boomer, but we have to be like the youngest of the boomers, right? We're really the very, very tail end of the boomers. Was it 1973? No, I think 1963, unfortunately, right? So the very tail end of the boomer situation. So you have that globalization, you have boomers retiring, and there is a skills gap. You know, I think something, the president did mention it last night, just like every other president I've heard in my adult life. When I was in high school, there were kids who maybe didn't excel in math and science and English, and they took shop. And those guys are making $100,000 a year today because they took shop. Now, there was a view pejoratively on people who took shop. I think we've gotten away from that. And if you consider the need for trade, the need for infrastructure, the American Society of Civil Engineers is talking about, the president's talking about $1 trillion public-private partnership. The American Society of Civil Engineers say we actually need $5 trillion over the course of the next decade. You really dig deeper with some of these guys, and they say, well, if we tried to do $5 trillion over a decade, no trains would be running, no cars could get on a highway because we just have so much work going on. There'd be too much traffic, there'd be too much backup. So it's really a generational standpoint. And I think, if you look deeper into the unemployment situation, the big classic economic debate, is it structural or is it cyclical? Is it secular, long-term deal, or is it cyclical? Janet Yellen is an advocate that it has been a cyclical event. It doesn't matter what I think, but I think it's secular. Because if you look at the unemployment rate relative to high school or college educated, there's a wide gap. And non-high school grads, it's even higher. So if it's college educated, it might be 3%, high school educated might be 6%, and non-high school educated, it's probably 9%, something along those lines. So to the degree we're able to address some of those issues in our state university system, community college system, I think that would go a long way, because the infrastructure is going to be a big deal, and I think there needs to be honor and dignity to that sort of role. And if you vote for me in November, I'll see to it that I get that done. Joe Kennedy III has nothing on me, right? The Irishman with pasty skin, step up and talk after the president. So be mindful of some of those dynamics going on, which is all why, even with the tax cut, even with a renewed surge for business investment, we're in a situation where I don't think we really creep much higher than that 3% rate of growth. We had a couple of 3% prints over the last couple of quarters, but when you look at the dynamics that have been driving that, real final sales is GDP less inventory buildup. And inventory buildup had a lot to do with the 3% prints we saw the past couple of quarters. I'm more of an advocate of real final sales because that gives you a better indication of what's happening in the economy. And again, the Fed has been driving it, and it's been a global phenomenon. You see here in the chart, central bank balance sheets. Now what's the one thing investors are not supposed to say. It's different this time, right? Well, I just said it, and I want you to repeat after me. It's different this time. Not good enough. Much better, much better. Why is it different this time? Because central banks have quintupled their balance sheets over the last 5 years, 7 years, 8 years, artificially suppressing the short end of the curve, really leveling the playing field. What resulted in that? All companies had access to low and an invariable cost of capital. You couldn't separate the strong from the weak. Everybody had the same hand. Now people will be dealt a poor hand, but they'll be dealt a poor hand because of their own fault. So we'll be able to separate this now, and I think that's going to be an important development. Our Federal Reserve, again, taking rates from historically low to merely ridiculously low. Okay, we think rates are going to rise 3 times in 2018, maybe twice in 2019, and then we're probably going to chug along and just wait for the next recession, whether it's 20 or 21. The idea that the next recession will be 2008 or 2000, I want you to be prepared for that. I don't think that's the case. We're only growing 2.5%. 2% growth rate, it's like stepping off a curb. Okay, I don't want to be overly dismissive of the pain that a recession can cause, but the idea that it's going to be a 2008 type scenario, we don't have the leverage in the system that enabled us to grow 5 and 6% like we did in 2005, 2006, 2007. So that excess leverage will not be the leveraged risk that took us down by 5 and 6% in 2018 and 2019. I'm sorry, 2008 and 2009. I submit the next recession, when it happens, will have occurred by the time we realize it. Because it is different this time, because we don't have the leverage. There's so much money that's having been created, and businesses are still only putting it to use now. Our Federal Reserve, 3 times this year, the European Central Bank, headed by Mario Draghi, last week he basically said, we're not raising rates this year, but the market still boosted up the euro because the market wants to believe that he's going to raise rates. He's not going to raise rates. I mean, he's from Italy himself. He knows how screwed up it is there. He's not going to raise rates until you get clarity on the Italian election. He is reducing his monthly purchases of sovereign credit bonds from $60 billion a month to $30 billion a month, but he still has a negative interest rate, and he still has monthly purchases going on, quantitative easing. And then in Japan, you know, they've done a pretty good job. Shinzo Abe always talks about the 3 arrows: government spending, monetary policy, but economic reforms. I mean, he's hit the ball out of the park twice on government spending and monetary policy, but opening arms to immigration, women in the workforce, they still have a long way to go from an economic reform standpoint. So Abe, you know, he's a deft politician because he waited for the arc of his popularity rankings to call a new election, and he increased his support in government. So from a standpoint globally, how to invest, we're going to overweight the U.S. We're going to overweight stocks relative to bonds. In your European and Japanese holdings, when you go international, look for opportunities. I think you're still going to see, because monetary policy is still playing such a critical role there, I think you're going to see better performance from your passive investments or your index funds, because central bank policy is still kind of lifting all boats, rising tide lifting all boats, if you will, in Japan and in Europe. But in the emerging space, we still think it's going to be an environment where you're separating winners from the losers, even though I think the dollar is going to become less weak. Okay, as the dollar becomes less weak, you know, the Fed's mantra and the Fed's mandate is to keep a lid on inflation and to maintain full employment. Their unofficial mandate is not allow the dollar to get too strong. Because what Janet Yellen and now Jay Powell have to contend with is that the emerging space makes up more than 1/2 of global GDP. Okay, the consequence for that is our dollar can't get too strong because 6 billion people can't afford to have inflation. It's $3.5 or $4 trillion in emerging market debt, dollar-denominated emerging market debt. Jay Powell can't raise rates too much, have those emerging currencies get too weak, and they'd be unable to service interest payments on that $3 or $4 trillion in dollar-denominated debt. More important, food and energy. In the West, food makes up maybe 10% of our pricing measures. In the East, it makes up more than 1/3. cause another global financial crisis, nor can we cause a global recession. So lower and for longer, we think, is going to continue and to persist. So within the bond market, we expect flat to low returns. You no longer have the Federal Reserve supporting the Treasury market any longer, right? They are going to let some assets roll off their balance sheet in a very measured pace. When you don't have the Fed supporting rates, that is a very big concern. What we have here is the yield curve. The yield curve is the interest rate differential between the 10-year Treasury, the benchmark, and the 2-year Treasury bond. That yield curve has been flattening. The market is freaking out because the yield curve is flattening. I think the yield curve is flattening for one reason. We suck less than everybody else. All right? So the two things you have to take home with you during three things you have to take home with you during periods of market volatility. My daughter, the great investor, how many points are left? It's different this time, and we suck less. Those are your 3 points that you have to take home with you. We suck less because the global investment marketplace is confident in the largest bond market in the world to grow at about a 2.5% non-inflationary rate. They're confident in our ability to service interest payments on that debt. And to make the math easier, I want you to think of bonds as stocks. 10-year Treasury bond, it's 270, but the math's too hard. So at 250, 250 is division, right? 2.5%, inverse that. 1,000 par value on the bond, over 250, that would be a PE of 40 times. You and I would think that's expensive, right? But if you look at the German Bund, which might be yielding 1/2 of 1%, take the inverse of that, that's trading at 200 times. If you look at the Japanese government bond, which might be yielding 1 basis point on a $1,000 par value, that is a PE of 1,000. So my new friends, we suck less, trading at only 40 times that 2.5% you can get on the 10-year Treasury bond. So I think that's why we're seeing the 10-year yield curve flatten. We don't think it's looming recession. Historically, when the curve flattens, when you get to 50 basis points, 1/2 of 1%, the difference between 10-year yield and 2-year, like we're seeing now, historically it takes 2 years from a 50 basis point spread to a 0 or inverted spread, when actually the 2-year Treasury is yielding more than the 10-year Treasury. And historically, that has positioned the economy for a recession. But over that time period, the median return, the middle return, is 21%, and it's taken 2 years. The average return over the last 5 cycles is 67%. Erase that from your mind, though, because I don't want to think about 67% over the next 2 years. I'm much more happy with the median 21% total return over the next couple of years. I think that is probably a more likely outcome. I'd love to see 67% like the rest of you, but I don't think that's the case. So be mindful that we suck less, and that's the bid on the 10-year. We don't see stress in the credit markets. That is really key when you think about what's happened with the 10-year just going from 205 in September, then the president and Pelosi and Schumer were all arm in arm, buddy-buddy. Who expected that? 10-year went from 205, now this morning we're at 270. Okay, that's been an amazing increase compared to what we've experienced these last 7 or 8 years. But there's been no stress in the credit default swap market. There's been no stress. The interest rate differential between investment-grade corporates and high yields continues to narrow. So that tells me there's no stress in the credit market. When I talked about global yields already, 10-year at 250, the German Bund and the JGB at significantly more expensive levels. We think sovereign credits are an area that you should avoid when we're positioning portfolios within our fixed income area. We want to make sure we have exposure to investment-grade corporates. We think high-quality bonds are the best way to go, but we want to make sure we're above benchmark credit risk, but below benchmark interest rate risk, because as the Fed raises the long end, we'll get hit more. Mortgage-backed securities, bank loans. Bank loans have low interest rate sensitivity, but you have to be careful of the quality. So on the high yield and the bank side, and the, the high yield bonds, sprinkle that within your portfolios. We want the bulk of your portfolio and fixed income to be more on the investment grade corporate side. From the equity standpoint, we see double-digit stock returns this year when you consider what we have seen these last several years. We basically had flat profit growth in 2014, 2015, and 2016. Profits grew about 10% for 2017. We're learning that just now. Because of the tax law, it's possible that we could see earnings growth of upwards of 14% this year. And next year could be as high as 10%. So we think this, as you see here, the S&P 500, basically kind of a straight line. We think that volatility is going to increase for 3 reasons. Last year, we had no days below 5%, where the market fell from a peak to a trough of 5% over the course of the entire year. Every month last year, we had positive total return. That has never happened. This is an extraordinary low period of volatility, and that's why everybody freaked out Monday and Tuesday. Okay, but be mindful of the fact that it's an extraordinary period. It's different this time because the Fed has printed all this money. The largest bond, or the largest equity index in the U.S. is the Wilshire 5000 index. Along the lines of who's buried in Grant's tomb, how many companies are in the Wilshire 5000 index? 5,000, good guess. Wrong. I get your book. I get 2 books now. 3,700 companies are in the Wilshire 5000. That many companies have gone down, have LBO'd, have merged in the last 9 years. What have those 3,700 companies been doing? Buying back shares. So the Federal Reserve has created an additional $3.5 trillion out of thin air over the course of the last decade, yet we have 1,300 fewer companies publicly traded which have been buying back shares. We have more dollars chasing fewer bonds, which is why that chart is going from LA to Portland, Maine, okay, with a very narrow volatility. When you have new Fed chairman, the market typically falls by 15% that calendar year, peak to trough. It's up 25% the following year, so you make up your classic 8% type return, but it's a volatile period. When you have periods below 5% volatility the prior year, the next year you have a 12% drawdown in the market. The average return that year is 8%, average annual return. When you have midterm elections, the average drawdown is 30%. And I think it's conceivable this could be the most screwed up midterm election any of us have seen in our adult lives. So maybe we see more than 30%, maybe we see less. 12 months later, the market has, it's a 15% correction. 12 months later, you're up 30%. Okay, I want to get that right. So it's down more, up more over the course of the following 2 years. So be mindful, volatility is going to increase, but every time we have volatility, think about profits, because we've basically been in a profits recession. Now we have profits growing in the mid-teens this year, and another 10% or so next year. And that's not just a domestic phenomenon. It's a global situation. We had a chart earlier talking about U.S. growth, developed growth, and emerging growth. Okay? Not coincidentally, it's not coincidental that you're seeing profit growth rise in a similar fashion. U.S. profits growing faster than European profits, emerging profits growing faster than both. So it is a global phenomenon, and we think that is a great opportunity for investors when they're investing. We've seen emerging markets outperform developed markets over these last couple of years, but what we really believe from a valuation standpoint, even though emerging is starting to gain some traction, emerging markets are still only trading about 12 or 13 times earnings. Developed markets are about 18 times earnings. So valuation is still clearly evident in the emerging space. So we're continuing to overweight emerging. I talked about small caps, beneficiary of the dollar, and tax reform, industrials, financials, technology, beneficiaries of tax reform, repatriation, increased business investment, reduced regulation on the bank side. So we think, which is kind of an out-of-body experience for me. I'm in year 9 of the cycle, and I'm leaning small cap relative to the benchmark. I'm leaning value relative to the benchmark. So it's not really what you should be at this point, but that is because it's different this time. And because it's different this time, you have to play the hand you're dealt. And that's one thing I've learned over the last 30 years. Play the hand you're dealt, see how it's coming to fruition, and always act in accordance with interest rates, with what GDP is doing, what inflation is doing, and ultimately the impact on corporate profitability. I mentioned earlier how this would be an environment that would be conducive to active management, so I've kind of hyped on that enough, I believe. Now for the words you've all been waiting for. In conclusion, market volatility is going to increase. It's going to. We are going to have recession someday. We believe it's unlikely to occur in 18 or 19 given the global and domestic tailwinds we have behind us relative to economic demand and relative to tax policy and relative to interest rates. Okay? We think that the return of the business cycle will play out not only in policy decisions, we're seeing that transition into economic activity, and then ultimately from an interest rate standpoint, not as high as people feared. That'll have an impact on the dollar, but not as much, right? Because the dollar will be less weak. And within the bond market, it's been a 35-year bull market. It had to end sometime, but we're not convinced the bear market in bonds has begun. There's an income generation phase to the credit cycle whereby one can clip coupons. And if you can get 3% or 3.25% on investment-grade corporates to augment income and clip those coupons, have at it. And within the equity market, don't look for PE multiple expansion to help drive growth. We think it's going to be an environment where earnings growth can run commensurate with profit growth, and I think that's how you're going to get your total return when you factor dividends into that. So thank you all very much for your attention today. I appreciate your participation. Again, LPL Financial is delighted with the partnership with Vectra Bank. And Bruce, I want to thank you. It's been my honor and privilege to share with you today. Thank you. Appreciate it.